Okay, let's go through the minutes. We're going to go through just a bit on the staff economic outlook, and then we'll spend most of our time on the participants' view of current conditions and the economic outlook. CPI was released this morning. Not bad. There were a lot of good things to be happy about if you were hoping that the Fed was going to be near the end of the rate hiking cycle. It does look like there's probably one more and it's done. If there is one more, we'll have to see about the incoming data coming in. Market spiked, futures up 40 points, and then it drifted all away, and then it started to build into the minutes. Minutes were released, and about 15 minutes later, the market just decided that's it and started heading pretty much straight down, finished near the lows of the day. So let's see what was in here. For the staff economic outlook, first paragraph, this is new. For some time, the forecast for the U.S. economy prepared by the staff had featured subdued real GDP growth for this year and some softening in the labor market. Given their assessment of the potential economic effects of the recent banking sector developments, the staff's projection at the time of the March meeting included a mild recession starting later this year with a recovery over the subsequent 2 years, two-year recovery. Mild recession. That's their baseline. So negative growth, slightly negative growth later this year, followed by 2 years of rather low growth. The last paragraph here, they sort of give a double-sided case. If the effects of the recent developments in the banking sector on macroeconomic conditions were to abate quickly. Now, when they say the effects, I imagine they must be talking about credit tightening, not the liquidity effects, the credit tightening. If the effects of the recent developments were to abate quickly, then the risks around the baseline would be tilted to the upside for both economic activity and inflation. So what they're saying is that, listen, if it doesn't affect credit, then the economy will be fine, but inflation will still be the enemy of the day. If banking and financial conditions and their effects on macroeconomic conditions were to deteriorate more than assumed in the baseline, then the risks around the baseline would be skewed to the downside for both economic activity and inflation. And this is important, particularly because historical recessions related to financial market problems tend to be more severe and persistent than average recessions. So given that we're standing kind of beside a potential financial market problem, you really think we should be pushing up to 19 times forward earnings on declining earnings? I read that and I think, well, shouldn't we be somewhat concerned about that and conservative in our forward multiple? It just doesn't seem that we are. Let's go on to the participants' view. This was the staff economic outlook. This is participants. So these are the board of governors, the voting members, and the other presidents of the federal banks. In their discussion of current economic conditions, participants noted that recent indicators pointed to modest growth in spending and production. I don't know where they're seeing modest growth in production. All the PMIs are below 50. If you look at the Chicago Activity Index, the Richmond Fed, the Dallas Manufacturing Index, if you look at all these indexes, they're all in contraction. So I'm not quite sure where they're seeing modest growth in production. Anyways, that's what they're seeing in that room. At the same time, though, participants noted that job gains had picked up in recent months and were running at a robust pace. The unemployment rate had remained low. Inflation had remained elevated. They're not saying that wage growth is robust. They're saying job gains are robust. They're not talking about the cost of those jobs. They're just talking about the gains. That's interesting. They commented that recent developments in the banking sector were likely to result in tighter credit conditions for households and for businesses and to weigh on economic activity, hiring, and inflation. So they said, hey, listen, you got this thing going on. But then, against this background, participants continued to be highly attentive to inflation risks. All of that is going on, but eye on the prize. We're looking at inflation. Now, their preferred measure is the PCE. CPI came in pretty good today. If you look at services, Core services, ex-housing, it was below 0.3, something like 0.29, which isn't bad, 0.29. However, the PCE has a lower component for housing, so they prefer the PCE, so we're going to have to wait a couple more weeks to see the PCE measure. This stuff gets really interesting. I know it looks like I got a lot of yellow highlighted, but it was trying to pick which things not to point out. And if I didn't highlight something, I ran the risk of somebody saying, that wasn't important then. I think you should read the whole thing. In assessing the economic outlook, participants noted that since they met in February, data on inflation, employment, and economic activity generally came in stronger than expected. They also noted, however, that the developments in the banking sector that had occurred late in the intermeeting period affected their views of the economic and policy outlook and the uncertainty surrounding that outlook. Based on incoming economic data, participants' assessments of the effects of cumulative policy firming and their initial views on the likely economic effect of the recent banking sector developments, participants generally expected real GDP to grow this year at a pace well below its long-run trend rate. They're not forecasting a mild recession. It's going to grow, real GDP will grow, but below its long-run trend rate. With inflation remaining unacceptably high, look at that adjective, unacceptably high, participants expected that a period of below-trend growth in real GDP would be needed to bring down aggregate demand into better balance with aggregate supply and thereby reduce inflationary pressures. So this idea that as soon as the economy gets weak, the Fed will cut and we'll get 4 rate cuts by the end of the year, this sentence basically says, look, they are comfortable with it. They anticipate that that is what is going to be needed to make sure Pandora is back in the box, Pandora being inflation. Many participants remarked that the incoming data before the onset of the banking sector stresses had led them to see the appropriate path for the federal funds rate as somewhat higher than their assessment at the time of the December meeting. After incorporating the banking sector developments, participants indicated that their policy rate projections were now about unchanged from December. Okay, let's just take that sentence for a minute. They're saying, hey, listen, because this thing happened in the banking system, it will act as some tightening in the economy, so maybe we don't have to use rates to do it. But up here, the staff is saying, if this doesn't cause any real problems, then economic activity and inflation risks are tilted to the upside. And if it doesn't cause any problems, then what they're saying over here about credit tightening doing some of the work for them would not happen. Hence, they would have to do some work. So either there is going to be a credit restriction in the banking sector that allows the Fed to pause, or there is not, which will allow the Fed to raise. Either way you look at it, the outcome is not positive, I think. Participants assessed that the development so far would likely lead to some weakening of credit conditions, as some banks were likely to tighten lending standards amid rising funding costs and increased concerns about liquidity. Well, I think that is probably a fair assessment. And then they go on to talk about the household sector and then the business sector here. So here's the household sector. Incoming data on real consumer expenditures showed a pickup in spending in January and February, and Friday we get retail sales for March. They attributed the pickup to strong job gains, which we also saw for March, rising real disposable income, given that CPI for March came in lower, the headline, which includes food and energy, which all people pay for. Well, that came in lower as well, so real incomes were also strong in March. Households continue to run down excess savings accumulated during the pandemic. They also noted that an atypically warm start to this year, along with the challenges in seasonally adjusting data, likely contributed to the pickup in the reported data. Well, you want to talk about warm. It was, I think, 23 degrees Celsius here today, which was pretty warm. It's going to be 26 tomorrow. Participants noted that recent developments in the banking sector and the associated rise in uncertainty would likely weigh on consumer sentiment, and that increased caution on the part of consumers could restrain spending. I don't know. You know, if you listen to my market outlook on Sunday, I had to remind, the market that there was a banking issue a couple of weeks ago, because it seemed like the market has just completely forgotten all about it. No one's really talking about it anymore. It seems to be gone, buried away, and yeah, it happened, and it's over, and it's good. Is this going to weigh on consumer sentiment? The consumer has such a short memory that I think most of them have probably just forgotten it. They get their paycheck, and 70% of them head to the malls, and they spend every penny they make. I don't know if it's going to weigh on consumer sentiment. I think it'll affect bank lending. So there are some people out there who aren't going to be able to get that new car because they're not going to be able to get financing. I think that'll weigh on their sentiment and, I can't get a car. But they'll go spend the money on something else. Regarding the business sector, growth in business fixed investment was being restrained by tighter financial conditions that reflected cumulative policy firming to date. Participants expected the likely tightening of credit conditions due to the recent developments in the banking sector to further weigh on investment spending. So they're pointing out two things here. The cumulative effect of all the rate hikes and tighter credit standards probably from some of the banks, or a significant amount of the banks. In addition, the banking sector developments could damp business confidence and increase firms' caution, reducing their willingness to hire new workers. Haven't seen that for March. See if that plays out in May after the central bank meeting. May 5th, we get the April jobs report. It seems we just get past one and we're looking to the next, right? The next one will solve everything. The next one will tell us all the answers we need. However, a few participants mentioned that their non-bank business contacts reported that the banking sector development so far had not resulted in significant changes in their hiring and capital spending plans or sales expectations, though their contacts also acknowledged increased uncertainties around their outlooks. Participants agreed that the labor market remained very tight. Participants noted some signs of improvements in the imbalances between demand and supply in the labor market, including further declines in the quits rate, as well as an increase in the overall labor force participation rate and the return of the prime age participation rate to pre-pandemic levels. Well, we saw the quits rate last month, and we got the JOLTS report last week. We saw the quits rate last month jump back over 4 million. So that negates what they just said there, saying a further decline in the quits rate. Well, that just went right back up. But there still was an increase in the participation rate, so 50-50. They lose on one, they win on the other. Furthermore, participants observed that wage growth appeared to be slowing gradually amid this apparent easing in labor demand and increase in labor supply. And at the end of the month, we get the key metric of wage inflation, which is the Employment Cost Index, the ECI. That's done quarterly. So for January, February, March, we'll see that right at the end of April. The average hourly earnings, remember, is a mix. It's a mix of the type of jobs along with the pay that those jobs have. But the ECI is just a measure of employment cost. Everything is in that. So that's what we want to see there. Where are we? Wage growth appeared to be slowing. However, participants assessed that labor demand continued to be, and look at that adjective, substantially, that labor demand continued to substantially exceed labor supply, and several participants pointed out that wage growth was still well above the rates that would be consistent over the longer run with the 2% inflation objective given current estimates of trend productivity growth. And that is the big thing, right? Trend productivity. If you can get productivity up, you get wage costs down because if you are paying somebody 10% more, but they can produce 15% more, you actually lower your per unit costs. So you can justify a higher than normal wage inflation if you have higher than normal productivity. But productivity has been coming in negative for some time, making the cost per unit much higher than it needs to be, or much higher than it would be if productivity at least remained flat. Giving current estimates of trend productivity, well above rates that would be consistent given current estimates of trend productivity. With inflation still well above the committee's longer run goal of 2%, participants agreed that inflation was unacceptably high. You got to pay attention to these adjectives here. Substantially. This is the second time we've seen unacceptably in relation to the word high. Regarding prices for core services excluding housing, participants agreed that there was little evidence pointing to disinflation in this component, while the CPI today gave some evidence that it is abating. So there's a win for the Fed there. Participants generally judged that some more easing in the labor market tightness and slowing in nominal wage growth would be necessary for sustained disinflation. Sustained disinflation, as opposed to maybe this disinflationary period might be just cyclical. And now we'll see it resume if we allow economic growth to accelerate forward. So you have to keep a cap on that, because you got 3.5% unemployment. Where are you going to get the workers from, right? What, are we going to go to 2% unemployment? Participants saw risks to economic activity as weighed to the downside, and I'll agree with that. As a source of downside risk to activity, they noted the possibility that banks would reduce the supply of credit by more than expected, which could restrain economic activity significantly. So listen, the conference calls, the earnings calls for banks are going to be really important, because I guarantee you every single analyst is going to ask that question. And every conference call is going to anticipate that every analyst is going to ask that question, and they're going to give forward guidance for that. So forward guidance on the banking book is going to be important. Listen to their numbers for what they believe credit growth will be, or loan growth will be over the next quarter or the next year, however long they give guidance, and pay attention to the provision for loan losses. It would be odd that they don't increase. So provision for loan losses will increase, and let's see if their loan growth projections decrease from last quarter. And if that comes in lower and loan loss provisions are higher, as I said on Sunday's Market Outlook, I don't know how we can be suggesting that 2023 bank earnings will be 20% higher than 2022's bank earnings, because we're all the IPOs, we're all the underwriting deals. Now, they're not going to make it on that side of the business. So I'm skeptical, but that's going to be important to listen to, is their forecast for loan growth. And they don't tell us here. They say it'll reduce the supply of credit, but they don't tell us by how much or give us a number. But if it says more than expected, that's the thing. How am I going to know when I listen to loan growth projections and they're lower than last quarter? How am I going to know that that was what they were expecting, or that it was more than what they expected? I won't know. Participants generally saw risks to inflation as weighed to the upside. That has not changed. Though they also recognize some downside risks to inflation. This is new. As a source of upside risk to inflation, participants cited the possibility of more persistent than anticipated price pressures due to, for example, surprisingly resilient labor demand. As a source of downside risk to inflation, participants noted that if banks reduce the supply of credit by more than expected, the likely restraint on economic activity and hiring could put additional downward pressure on inflation. Okay. Several participants noted that in their policy deliberations, they considered whether it would be appropriate to hold the target range steady at this meeting. They noted that doing so would allow more time to assess the financial and economic effects of recent banking sector developments and of the cumulative tightening of monetary policy. So several participants thought, maybe we should just hang out here. However, these participants also observed that the actions taken by the Federal Reserve in coordination with other government agencies help calm conditions in the banking sector and lessen the near-term risks to economic activity and inflation. Consequently, these participants judged it appropriate to increase the target range 25 basis points because of elevated inflation, the strength of the recent economic data, and their commitment to bring inflation down to the committee's 2% long-run goal. In the press conference, we were aware that some participants, Powell had said in the weeks leading up to the press conference, there were some participants that discussed being on pause leading into it. They usually have a whole bunch of discussions before they get into the meeting, so they're pretty much all on the same page when they're in the meeting. Everyone's already made up their mind when they head in there. And some were considering holding. It's the however, right? However, they said, you know what, liquidity was restored. We did handle the problem. It was a liquidity problem. It was mismanagement by a few banks. They go on to say that a little bit later. Yeah, okay, let's go 25. This really surprised me. Some participants noted that given persistently high inflation, now keep in mind, this paragraph is being written after the banking crisis. Okay, keep in mind. Some participants noted that given persistently high inflation and the strength of the recent economic data, they would have considered a 50 basis point increase in the target range to have been appropriate at this meeting in the absence of the recent developments in the banking sector. They were willing to go 50. And they saw, okay, well, you got this thing going on. Maybe that counts for 25, so let's go 25. However, due to the potential for banking sector developments to tighten financial conditions and to weigh on economic activity and inflation, they judged it prudent to increase the target range by a smaller increment at this meeting. So, if this does not constrain loan growth, if it doesn't constrain availability of credit, these participants who wanted to go 50 are going to come back to in the May meeting and say, you know what, it didn't have the effect we thought it would. So that 25 I gave up last time, yeah, that's on the table. So they might, there might be more weight to the 25 for May, which I think today the probabilities from Fed Watch Tool were 70%. They went as high as 76% today, but came back down to 70% by the end of the day. Participants noted that the most significant issues appeared to have been limited to a small number of banks with poor risk management practices and that the banking system remained sound and resilient. How many Fed speakers have we heard repeat the same word, sound and resilient, right? I think this is the last one we get to right here. In discussing the policy outlook, participants observed that inflation remained much too high, the labor market remained tight. As a result, they anticipated that some additional policy firming may be appropriate to attain a sufficiently restrictive policy stance to return inflation to 2%. Many participants noted that the likely effects of the recent banking sector developments on economic activity and inflation had led them to lower their assessment of the federal funds target range that would be sufficiently restrictive compared with assessments based solely on the recent economic data. So they had decided to go 25 basis points, and this paragraph is saying some additional policy firming may be appropriate to attain a sufficiently restrictive policy stance. And there it is. I think the powerful statements are some people were going into this without the banking crisis, were going into it with a 50. We're going into that saying we got to move 50. And the staff up here saying we see a mild recession starting later this year. Now, the staff can say that, but the members can't say that because, well, Congress is going to say, okay, you are actually now planning a recession. And that is going to be a political problem. So they really can't say that. But it's interesting that the staff said it and they printed it. Anyways, there we are for the minutes. I do encourage you, each time the minutes come out, read the whole thing. A lot of the stuff is narrative. In other words, they're just recounting some of the things that have happened in financial markets and credit markets, etc. But it is important that you know what they're looking at when they're in there. So that you don't say, well, credit spreads are this. They're not even paying attention. Well, they do talk about that. Well, the reverse repos, well, they do talk about the reverse repo. So that you can see throughout this statement that they are talking about all this stuff. They're not ignorant to these facts. They are aware of all of these facts. They talk about all of it. All of it is presented. There's staff presentations and there's participant discussions. All of it is in there. Okay, that's it. A reminder, on Sunday at 6 p.m. New York time, I will be doing a live YouTube, and the topic of discussion will be anything related to the market outlook, anything related to markets. It's not about CFA stuff at all, although if there is a CFA question, I'll answer it. And it's not about the applied series at all, but if there's a question about that, I'll answer that too. It really is about your questions about whatever flows from the market outlook that I do on Sunday and whatever questions you happen to have. That's 6 o'clock on Sunday, 6 p.m. That's pretty much when Globex opens. So no matter where in the world you are, if you're not sure where New York time is in your time zone, just think, well, when does Globex open in my city? And that's the time. I will see you then.